Value investing philosophy, a deeper dive. Fundamental analysis. At the heart of value investing is fundamental analysis. Warren Buffett meticulously examines a company's financial statements to understand its true worth. He looks at factors such as earnings, cash flow, and assets. By analyzing these fundamentals, he can gauge whether a company is undervalued or overvalued in the market. Competitive advantage. Buffett seeks out companies with a competitive advantage or economic moat. What does that mean? A competitive advantage could be a strong brand, unique technology, or a dominant market position. These advantages allow a company to maintain profitability and fend off competition. Types of competitive advantages. Brand power. A recognizable and trusted brand is a powerful competitive advantage. Companies like Coca-Cola and Apple enjoy strong brand power, which translates into customer loyalty and pricing flexibility. Cost leadership. Some companies can produce goods or services at a lower cost than their competitors. This cost efficiency creates a competitive edge, as it allows for higher profit margins or the ability to offer lower prices to consumers. Network effects. Network effects occur when the value of a product or service increases as more people use it. Social media platforms like Facebook and payment systems like PayPal thrive on network effects. Intellectual property. Companies with valuable patents, copyrights, or proprietary technology possess a competitive advantage. This intellectual property can create barriers to entry for competitors. Economies of scale. Large companies often benefit from economies of scale, which means their per-unit production costs decrease as they produce more. This cost advantage can make it challenging for smaller competitors to compete. The longevity of competitive advantage. What's essential to understand about competitive advantage is that it should be enduring. Buffett seeks businesses with moats that are likely to withstand challenges and competition over time. Coca-Cola. Coca-Cola is an excellent example of a company with a strong competitive advantage. Its brand is globally recognized and has been built over many decades. This brand power allows Coca-Cola to charge premium prices for its products and maintain a loyal customer base. Apple. Apple's competitive advantage lies in its combination of brand power, a closed ecosystem, and continuous innovation. The Apple brand is synonymous with quality and style, and its ecosystem of products and services keeps users locked into the Apple ecosystem. Buy and hold. One of the key principles of value investing, as practiced by Buffett, is the idea of buying and holding. He often says his ideal holding period is forever. This means he invests in companies with the intention of holding their stocks for the long term, sometimes even for decades. At its core, buy and hold means purchasing stocks with the intention of holding them for an extended period, regardless of short-term market fluctuations. It's an approach that emphasizes the importance of patience and a focus on a company's fundamental value rather than reacting to market volatility. When markets are down, emotions tend to run high. Fear, panic, and uncertainty can lead many investors to make hasty decisions. However, buy and hold encourages investors to resist these emotional reactions and stay committed to their long-term investment strategies. One of the key aspects of Warren Buffett's buy and hold philosophy is viewing market downturns as opportunities rather than crises. When stock prices decline, it often means that quality companies are available at lower prices. Buffett famously advises, "Be fearful when others are greedy, and greedy when others are fearful." During market downturns, Buffett remains committed to quality companies with strong fundamentals and competitive advantages. He trusts in the durability of these businesses to weather economic storms and emerge stronger. Historical perspective. To truly understand the power of buy and hold during market downturns, it's helpful to look at historical market performance. Despite occasional crashes and recessions, the overall trend of the stock market has been upward. Investors who stay the course and hold quality stocks through downturns tend to benefit from long-term growth. Fear and panic. One of the primary emotions investors experience during market downturns is fear. Seeing the value of their investments decline can trigger anxiety and panic. This fear often leads to irrational decisions, such as selling investments at a loss in an attempt to escape the downturn. Loss aversion. Investors tend to feel the pain of losses more acutely than the pleasure of gains. This aversion to losses can prompt hasty decisions to minimize perceived losses. Loss aversion suggests that we feel the pain of losing money more acutely than the pleasure of gaining the same amount. In the context of investing, this means that when investors see the value of their investments decline, they experience a significant emotional impact, often leading to fear, anxiety, and panic. Investors who are influenced by loss aversion may be more inclined to make impulsive decisions, such as selling their investments at a loss to avoid further declines. This response can be detrimental to long-term investment goals. Strategies to counter loss aversion. Set clear goals, establish specific investment goals and risk tolerance to guide your decisions. Diversify. Diversifying your portfolio can help reduce the impact of individual losses. Stay informed. Continually educate yourself about the companies you've invested in to make informed decisions. Focus on the long term. Remember that short-term market fluctuations are normal. Stay committed to your long-term investment strategy. Overreacting to market news. During market downturns, the constant bombardment of negative news can intensify emotions. Investors may overreact to sensationalized news, making impulsive decisions based on short-term information rather than a long-term investment strategy. The fear of missing out on potential gains or avoiding further losses can lead investors to follow the crowd. This herd mentality can cause mass selling or buying, exacerbating market volatility. Practical tips. Stay informed. Keep yourself informed about the companies you've invested in, so you can confidently assess their long-term prospects. Have a plan. Establish a clear investment plan that includes your goals and risk tolerance, and stick to it. Embrace volatility. Understand that market volatility is normal and can present opportunities. Avoid impulsive decisions. Resist the urge to make sudden changes to your portfolio based on emotions or short-term news. Seek perspective. Consider the bigger picture and historical market trends to maintain a long-term perspective. Margin of safety. Imagine you're constructing a bridge. You don't design it to support exactly the expected load, you build it with extra strength to ensure it can handle unforeseen stresses. Similarly, in investing, a margin of safety provides a buffer against unforeseen market volatility or unfavorable developments. Protection against losses. The primary role of the margin of safety is to protect investors from significant losses. In an unpredictable financial world, there are always risks, economic downturns, industry disruptions, or unforeseen events. The margin of safety acts as a financial safety net, cushioning the impact of adverse developments and helping investors stay afloat. Warren Buffett is a staunch advocate for the margin of safety, and he applies it methodically in his investment decisions. When considering an investment, Buffett begins by calculating the intrinsic value of a company. This intrinsic value represents his conservative estimate of what the company is truly worth, based on rigorous fundamental analysis. To calculate intrinsic value, Buffett considers numerous factors, such as earnings, cash flow, assets, and more. Beyond the numbers, he evaluates the company's competitive advantage, growth prospects, and industry conditions. By meticulously analyzing these elements, he arrives at a conservative intrinsic value. 5. Buying below intrinsic value. Here's where the margin of safety becomes paramount. Buffett doesn't just calculate intrinsic value, he insists on buying stocks when their market price is substantially below this intrinsic value. This approach ensures that even if his estimates are slightly off or if unforeseen challenges arise, there's a significant margin of safety to protect his investment. The power of waiting. Warren often compares investing to playing a game of chess, where careful planning and a long-term outlook are essential. Instead of constantly making moves, he waits for the optimal time to strike. Buffett's patience is reflected in his willingness to keep a substantial cash reserve. He understands that markets can be irrational and driven by emotion. By holding cash, he's prepared to take advantage of opportunities when others may be forced to sell at unfavorable prices. Buffett insists on buying stocks at prices significantly below their intrinsic value. This requires resisting the temptation to chase hot stocks during market frenzies. Buffett's patience is underpinned by a long-term perspective. He doesn't view investments as short-term bets but as ownership in businesses. This long-term outlook allows him to weather short-term market volatility and focus on the enduring value of his holdings. The contrarian approach. Patience often means going against the crowd. Buffett's contrarian approach involves buying when others are fearful. He understands that market sentiment can lead to mispricing, and patience allows him to capitalize on these opportunities. Contrarian investing is based on the idea that the majority is often wrong in the stock market. When the crowd is overly optimistic and bullish, prices tend to be inflated, creating overvalued stocks. Conversely, when the crowd is excessively pessimistic and bearish, prices can be depressed, leading to undervalued stocks. Emotional resilience. Patience is a testament to emotional resilience. Buffett maintains a calm and rational demeanor, even when markets are turbulent. This emotional discipline is a vital aspect of his ability to stay patient and stick to his investment principles. Buffett's patience also extends to learning from mistakes. He acknowledges that not every investment will be a success, but patience enables him to reflect on and learn from these experiences, making him a better investor over time. Buffett often waits for opportune moments to strike, particularly during market downturns. He subscribes to the belief that one should be fearful when others are greedy, and be greedy when others are fearful. During market panics or when specific industries fall out of favor, quality stocks can be available at significant discounts. Importantly, Buffett's investment decisions are devoid of emotional bias. He maintains rationality even when market sentiments are turbulent. This emotional discipline is an essential component of his successful value investing. If you found this exploration of Warren Buffett's investment philosophy enlightening, please subscribe as a favor to me. Remember, the path to successful investing is paved with knowledge and a commitment to time-tested principles.